right. Well, good afternoon. I am Dawn. I am the agency principal at Minnesota Insurance Group, and there are 5 of us. We are about half personal lines and half commercial lines. And one of the things that I do a lot of in the commercial sector is our computer, data, tech, IT clients. Their contracts are just as long and complicated as our construction clients. And over time, we've seen more and more requirements for PCI compliant insurance requirements or higher limits of liability or coverages that maybe are unaffordable or unattainable for some businesses. So I have some generic stuff to go over first, and then I'll hop into a couple of hot topics. And just a little bit of history on me. I love insurance. It doesn't make me necessarily popular at parties, so I try to spice it up a little bit. So as Patrick knows, I don't take myself too seriously in the rest of it. I do take our insurance very seriously, so bear with me as we go. Before I get started, I'm going to point out a couple of things, the did you knows. Driving laws. Just want to throw out a couple in case you travel around in a vehicle. In Alaska, it is illegal to tie a dog to the roof of your car. So I have been to Alaska, and just make sure if you go that you don't tie a dog to the roof of your car. In Derby, Kansas, it's considered a misdemeanor to screech your tires while driving. So make sure you drive a really safe mom vehicle of some kind. In Minnesota, it's actually illegal to cross state lines regardless if you're walking or driving with a duck on your head. So if you do cross into Wisconsin, that also transfers over to chickens. So the point of that is it is really important to read your contracts, know what the laws are, especially if you're working across states, different clients, things like that. I can't stress enough that insurance is not your first line of defense, and I'll point that out as I go through. It is really your last one, and as they talked about before, you have to have certain things in line, whether it's a homeowner's or a cybersecurity policy. You have to have it first before you get the insurance, because insurance is just the person or entity that pays. So I said the first lesson is always, always, always read your policy. And why? Well, the first thing I say is because we tell you that in our letters, because it helps protect us from errors and omissions. If we tell you, you have to read your policy first. The second reason is because what you see is not necessarily what you get. So there's a little bit of a difference here. I say the devil's in the details, and looks can be deceiving, and don't judge a book by its cover. And I say this a lot actually in the 18 years I've been doing insurance, because I can hold up 2 policies that are 81 pages, and all you see are stacks of paper with a staple in it. I can tell you that every line, every comma, every period, every definition, whether independent contractors are covered or not, whether you can have work comp in another state or not, all of that's in the details. So sometimes I bring red Solo cups and I'll put $5 under, and I say, now pick one. Well, you don't have any information, so you have to know what's inside all of that stuff. So Patrick did ask if I wanted a photographer to come out and take a picture for the new cover, and I said absolutely not. So what is insurance? What is it not? I can't stress enough, it is not a warranty plan like your cell phone. It's not a service plan like AAA, and it's not a financing plan like medical insurance. Anytime you buy something that can be canceled like this, where you have a couple claims and it can go away, or the market doesn't like you anymore and you have no claims and it can go away, this is not your first line of defense. WISPs for your company, alarm systems for your home or business, those are the first steps. Insurance is last. And I can't tell you how many, I love photos of crazy claims. My brother, my family, they're all car guys, so I see a lot of that. I actually have some claim photos, not in this one, of stuff from our clients in 18 years, but I talk about insurance it is actually a financial risk transfer method. You're going to give me $100 and I'm going to agree to pay something that we've outlined and agreed on. And it's going to be pretty specific. If it's only for red boxes and you have a fire and you lose blue boxes, I am going to read the policy. I'm going to tell you that I only agreed for the $100 to cover your red boxes. So it's just a method to transfer some of that risk. And I say it's a calculated decision where you really are exchanging all of that. And I go back down to it is just the person or entity that pays. So why? Because you really don't know why. Surprise. because you never just know when you might be grateful that you did. I'll give you a quick claim scenario. If you remember, was it 2 summers ago, or coming up on 2 summers with all the water that we had, and a lot of the cities had to shut down septic sewers, whatever. They had to make decisions because the amount of water flow that we had, and people's septics backed up and sewer lines backed up. If you did not have coverage for that on your home, condo, or renter's policy, the city's not responsible. It's an option to insure it. So you have to pay for that coverage, and there's a limit to it. And so it really is important to know what your options are, know what the cost is, and make an educated decision about whether you're going to pay to transfer it or not, because you just never know what's going to happen. I love the school buses in the back, by the way. When do people purchase insurance? Ideally, it's before their operations begin. We work a lot with entrepreneurs, and sometimes we get them here so we can help them prepare. That's not often, but it's during the planning stages. When people purchase, sometimes after they begin. They get going, and then they think about, I probably need this. And this is your self-insured stage. People go, I don't have coverage. Yeah, you do. It's in your pocket, right here, your checkbook, your credit card, your bank account, your home equity, wherever it is. If you don't purchase it when you start, then you're really self-insuring that. And that's the word I use, not uninsured. You're self-insured. So it just always amazed me. And then it's required. So we get this phone call. I'm trying to sign a lease today at 4 o'clock. They won't give me the keys until I show proof of insurance. And at that point, it's kind of hard for me to pull that out of a hat in 5 minutes. So, because I have to ask you, does it an alarm system? Is it sprinklered? How many square feet? What's the construction? When was the roof redone? So other things, you get a phone call from the Minnesota Department of Labor. Turns out you had an employee. Whether you thought they were an employee or not, they turned something in, and the Department of Labor says they're an employee and you didn't get work comp. A bank for a loan, but the biggest thing comes up in those prospective clients. So you start your business and you get going, and you're a service provider or a professional, and you get a contract. And it says in there, I will provide proof of insurance. And it might say 1 million liability, bodily injury. It might say 1 million in professional, work comp. You don't have employees. Do you need it? Your insurance agent should be a resource for you to help you walk through some of that contract negotiation. If you don't have employees, if they educate you, you can talk to your client and see if you can strike it from the policy. If you can't, you need to purchase it. So, but that's a lot of times when we end up talking to somebody is when they have a contractual need. And then risk management, it's an approach. So for our purposes, we are a risk management firm. I liken a lot of insurance to the fast food drive-through. You pull up to the drive-through, and they say, hi, how can I help you today? Well, I need an insurance policy for this contract for $1 million. Okay, would you like to supersize that with an umbrella, maybe a work comp policy? No, thank you. Okay, come on through the window, and you get your packet and with a staple, and you don't know what's in it. And so that's just selling you a product. At the end of the day, really it should be a conversation. Do you need that work comp coverage? Do you maybe not? We see contracts all the time where they ask for bodily injury and property damage, but you're a architect or a CPA or a service provider. Your biggest risk is your advice and your knowledge. They're not asking you for professional liability, but that doesn't mean you need it. It just means you're self-insuring it. So we talk about identifying, analyzing, and prioritizing what your risks are, and then figuring out ways to control it. And that goes back to, on the cyber, having a policy and taking steps first before you end up purchasing insurance. So that would just be a bummer. And I say, it really says other than buying insurance. And that's probably not an approach you hear from most insurance firms. It is not my first step to sell you anything and everything I possibly can. My job is to really try to keep you from purchasing things that you don't need and then having coverage where you haven't protected yourself and having claims. So my job is to keep all of us from going through a claim process because it's expensive for everybody, including us. We have to allocate people and resources and time. You have a deductible or it's uncovered. You're not happy with us, it's bad PR, and the company has to pay something. And you have a reduction in business, revenue, you know, whatever it is. So there's 5 quick steps. If you think about what you can do: avoid it, prevent it, reduce it, separate, segregation or duplication, and transfer. I fit into that last category. So risk avoidance, a couple things, is just not do it. If you call me today and you tell me you have a taxi firm, I'm going to give you the name and number of the place down in Minneapolis that writes taxis. I can do it. I don't want to do it. It's not worth it for me, and the risks outweigh the benefit. So I avoid that class of business. There's a couple other classes I avoid, and there's people I can tell on the phone I avoid. I don't want that client. I could tell you weren't honest. I know you're not forthright with your information, or I can tell you've shopped long enough to get the right answer when I ask you the right questions. So I will avoid that client because I don't need it in my office. And there's other things: declining jobs outside your skill set, you know, terminating employees that violate office policies. Risk prevention talks about frequency. So there are things you can't prevent at times. So keeping chemicals like away from a heat or a flame source if you're an auto shop. You can't stop a fire from happening, but you can prevent how often it happens. Protective eye gear. We've had clients who've had injuries on feet and eyes. Finally getting them to get steel-toed boots or eyewear, they reduce the number of claims that they have. A thing like written contracts, you know, for people that are service providers, is a good step. And then risk reduction really has to do with reducing the severity. So you can't stop a fire from happening in your office building. But if you install sprinklers, it won't be as bad. If you're a restaurant and you have an ANSEL system, rather than an outdated fire extinguisher that hasn't been tested in 10 years, chances are when the fire happens, because at some point it may in a restaurant, it will be a $5,000 fire, not an $85,000 fire. So reducing the severity of a claim. And then segregation duplication touches on your cyber part. I can't tell you how many times we have clients who have a loss, a data breach, a backup, a brownout, whatever it is, and all of a sudden it's costing them $10, $20, $50, $80,000 to restore their data in their systems, replace their equipment, and then it's kind of a soft cost. How much did they lose in PR, clients, revenue? Nobody knows. I can share personally that at our office we have a backup system, and 2 years ago at Thanksgiving, of course it happened over a holiday, so everybody's hours are 5 times the rate per hour, and we had a power surge, our system went down. When it was coming back up, it wouldn't load. Something, nobody still knows to this day what went wrong. But I had to order a new server, had to pay to have it expedited over from IBM, and I had to pay the tech people for 5 days over Thanksgiving to restore my data. Despite the fact that I had it all on our backup, it was still a $20,000 cost for me, and I was covered for all of it. So having that right coverage, all that wasn't even a data breach. It was just a power surge that somehow through the building and through all of our protective measures didn't do enough. But the backup was there, and we got it taken care of. So that's your duplication: sending something to the cloud, dividing where your data's duplicated or stored will help you get back up on and running as quickly as possible. So, and the last is risk transfer, and that's not how you transfer something, although I think that's exactly where she was headed. And at the bottom I put purchase insurance. It is really the last thing that you should do. But it's talking about having independent contractors sign a work contract, providing proof of insurance, making sure you have legal language like indemnification and hold harmless clauses, you know, things like that. And then the last thing is purchase insurance. If you do all the rest of this, your insurance will be cheaper. You'll pay less. I make less, but I have less claims, so we can work with more clients. So it kind of works really well. What if you don't buy insurance? Any risk that is not avoided or transferred. So the rest of them, reduce and prevent, you still have claims. They're just not as often or as severe. If you can't avoid it and you can't transfer it, it is a retained risk. Whether you have a deductible because you've chosen to insure it. Some of our professional policies have $50,000, $100,000 retentions. Now those are really big policies for pretty big exposures, but if you have a $5 million data loss, $50,000 at that point, chances are your clients are big enough and you're doing well enough. 50 is still a big number, but that's what they have to pay first in that case. Other things, if you carry a homeowner's deductible, it's no different. You're going to pay the first $2,500, for example. That water sewer example, or operating your business without insurance. You really are just signed up. Anything that you end up having to pay, you should know whether you intentionally or unintentionally agreed to, you're paying it. So I have a couple claims examples. They're kind of big. How much time do I have? Okay. I think I'm going to skip through some of these because I have a couple of claim things to talk about that are more data related. But I am going to touch on employment practices. Besides the cyber and the data, the other big issue right now that's come out is what we call employment practices liability. EPLI is the nickname. In your little handout is just a front and back, and it's the top 10 employment discrimination claims. And 10, 15 years ago, the only claims that really you heard about were your employee said you discriminated, you didn't do this or that. Now you have wage discrimination, like Walmart cases and stuff like that. And the big sprout has been in third party. So we talk about first and third party. First party's me in my own business. Third party's you as a client. You could be a vendor, you could be a client, you could be a customer, you could be a lot of different entities or people, but you're not internal to me. So the first party claims are, Kirsten works in my office, she says I have a hostile work environment, we have sexual harassment at our office, and she's told me several times I won't do anything about it, and finally she has to quit. This is not a suggestion, by the way, and then she sues because she was harassed. So first of all, if I don't have this coverage on my policy, and it is separate, it is not given to you, because you have to have steps in place to prevent it, like employee manuals. No employee manual, no EPLI. So if you have this coverage, you can turn it in, and they'll help defend that claim. And so if it's a real claim, you probably know you did it, and it's probably going to be a pretty big amount. The worst ones are the ones where you did have to terminate somebody for, performance issues, and they retaliated. So this little thing came out just recently, and it talked about the top 10 categories of types of claims. Sometimes a claim comes in 2 or 3. It could be 3 or 4 different types on the same claim, but retaliation is still 42% of all claims that go to EEOC. So almost half of all claims somebody files because they believe it was retaliatory to an action that you took. Race, sex, disability, age, national origin, religion, color, equal pay, and then Genetic Information Act. So those are the top 10 that are filed with the EEOC. On the back it says actually on the front it says there were 88,778 charges. On the back there was only 133 lawsuits on the merits. Of that, 22.5 million was awarded in court or settlement. Seems like a big number, never going to happen to me, but if you divide it, it's $169,173. So on the merits, that's what was awarded for employment practices. The thing that's come out now has been third party. So you come into my firm, you come into my store, and you feel that you've been harassed, you're not given the best deals, and you think it's because I'm a woman or I'm pregnant or I'm a certain religion, and I make a case that says I feel like I paid more for this product over the course of 5 years because of something discriminatory. So I'm a third party now, or I'm a vendor. I find out that 4 other vendors that sell you tires all got a better deal, but because I'm 75, I paid more because you thought you could take advantage of me based on my age. You'd have to have some reasons to back it up, but that's a third party. So your vendors, your client, somebody else claims it. So a good EPLI policy will have both for internal employees as well as third parties. So that's one thing I just want to stress is if you have customers, which probably you do if you're here, or employees, you should be talking to somebody about employment practices liability. You can get a small amount of coverage. If you don't do anything wrong, it's not too bad cost-wise. And it's usually we call it go away. I can pay somebody $10,000 or $12,000, $15,000 because they know they don't have a good claim, but it's cheaper to give them that than it is to pay $75 to fight it. It's when the real claims happen, that's the problem. And you don't know. If you have 2 or 3 or 4 employees, one of them could be harassing another one, and you don't know it. So, or if you don't take it seriously and take the right steps. So on the cyber stuff, let's see what else. Those are EPLI claims. Here's a good example on that. An auto technician said he was wrongfully terminated after filing a work comp claim. They said he was fired because he failed to give proper notice and left without authorization. They still gave him $2.5 million. So chances are there were some merits to that. They didn't have enough records to back up terminating. So, because they probably did. I mean, we get phone calls all the time. I have a guy with an injury. I don't want him to work here anymore. Doesn't work that way. And I can't tell you, you have to keep him, you have to work with him, you have to support him. If he's not working, talk to a lawyer, but otherwise you can't just fire him because he turned in a work comp claim and then later say he was a bad employee. I'll finish up. So on the cybersecurity stuff, once you get to a place where you're either required to have it or you're swiping credit cards, or you're keeping your client data. Client data is federal ID numbers and emails and things like that. Your sales projections. If you have sales revenue for your prospects, you have information that somebody else wants. If you have federal ID numbers, and if you have emails, if you have motor vehicle information, so you have name, address, date of birth, social security, any of that kind of stuff, you're impacted by all the laws that make it a requirement to report and disclose. So again, there's a first party and a third party coverage component to the cybersecurity. And your first party has to do with your costs if you have a breach. So at that point, you think about like loss of your data, loss of your assets, things like that. You might have some cyber extortion, or I hacked into your system for $20,000. I'll leave it alone. Those are damages you paid for. You have to pay out of pocket for. Some business interruption, that's a loss you have. You can't operate for 30 days. You can't sell your product or do your service. The third party has to do with, I'm your client and I was one of those disclosed, hacked places, records. So I want you to think for a second about insurance. If you have a homeowner's or a car and you have a claim, you call up your insurance company, you say, I actually have damage and it's $1,500 to fix it, so I want $1,500 minus my deductible. Okay, they come out, there is damage there. How many of you are going to get paid if you call up and said, I think I hit a raccoon, I think there's damage under my car. I would guess it's maybe $4,000, I'm not sure. But can you send me a check minus my deductible? Nobody's getting a check. But when you have a cyber loss or a data breach, you don't know that anyone's doing it. You have no idea if that thumb drive ended up going through the laundromat and nobody's information has been touched. You still have to report it, you still have to disclose it, and you're going to pay for my monitoring, and you're going to pay for the letters that go out and all the notifications, and it's like 200 and something per head per record. Yep. So yeah, I have a thumb drive in my pocket right now. It's got nothing super expensive on it, but if that gets stolen and I had records on it, I have to disclose. But there wasn't any damages yet. So that's been paid for by companies. The cost of the notification, the cost of the letters at $200 per head. You can now purchase insurance to reimburse yourself for these costs, even though we don't know yet that there's been a breach or a claim. That's your first party. PR. If you have a breach, someone's talking about how horrible you are. Look at Target. You need somebody well-versed and well-paid to tell them how great you are and how many wonderful steps you've taken to prevent that in the future. And that's a first-party expense. And your third party is, so I am Target, I've had my monitoring, whatever else happens and nothing goes wrong, but then I get breached. And I do have $5,000, $10,000 worth of losses that I had to be responsible for. That's that liability. So you always have 2 sets of coverages within any data policy that will cover, and you can choose sometimes only to cover one or the other, but at that point, that's what you're looking for when you're looking for a data security breach type policy, cyber. is first party and third party, and how those limits play out. So we will have clients that have $3 and $5 million in cyber, but they'll have $500,000 in that first party notification class. They can figure out how many records they have, and they can estimate what they think they might need. But when they're working with like HIPAA requirements or stuff, or maybe they have really high risk, they'll have a higher liability limit in case real damage does occur, but they have a limited number of records. So, and there are state, federal statutes. HIPAA is one of them. There's some foreign privacy protection requirements. You have the notification expenses, the PR expenses, and then you get penalties because the state loves to do that. So if you do have a breach, you're going to get monitored, and you may just get slapped with a penalty. From an insurance standpoint, like punitive damages is like sending your kid to timeout, but having somebody else do it for you. So it kind of loses the lesson. So a lot of insurance policies won't pay for punitive damages. It's a penalty that's not insurable. It's intended to make you think twice or 5 times or 100 times about what you just did. And hopefully you don't do it again. And if it's insurable in any way, shape, or form, some of these policies will have the most favorable language, but you just have to be aware that there is a likelihood that you will just get a flat-out penalty that is not insurable. So, so that's kind of that. I said, what can you do? The strongest thing I can tell you is you have to work with somebody who isn't your fast food insurance professional. When you're dealing with a business, and I even say it's for personal lines as well, you need someone who you can ask questions of, who will provide you with resources far in advance of, can I sell you a policy for that? You know, ask questions. They should ask questions. They should understand your business. And they should be approaching you from a risk management standpoint. You need to ask questions, and you need to be honest. If you don't tell your person what you're doing or how your exposure is, they can't help you and they can't insure it. And you really are just signing up for a fight, in my opinion. Seek ways to avoid, reduce, or transfer those risks. And be willing and interested to make changes in your business practice that can reduce those premiums. I had a janitor, a home cleaner. She wanted to do babysitting on the side. I kind of had to explain, how much money do you make from that? You know, is it really that much of a revenue generator? I got to tell you how this is going to play out if you have a kid who's hurt or injured. You're putting your whole business at risk for how much? If you make that much money doing daycare, stop doing the janitorial, because you know you can't make fuzzy rabbits and explosives all in the same warehouse. It just, you know, you're going to end up paying the explosives rate for your fuzzy bunny rate. And that's actually an example I give people. But, you know, I love this one. But, you know, we get a little trigger happy at our office sometimes. I see clauses in contracts, and I do panic. I do say, does this person know that they've already signed this contract? You have a lot less leverage to negotiate it out once you've signed it. So send it to your broker and make sure that they understand. And I use the word broker. That means that they're an independent. They can go from Philadelphia to Lloyd's of London to, you know, Hartford to Hanover, and try to find you the right language, the right coverage at the best price to meet your needs. So, and I threw in a couple of example clients because we work with everything from tiny little, you know, I have a makeup artist, we have some marinas, we have a website designer, you know, we have pizza franchises. It's all about, you know, these are clients that we have that really look to us to be their partner. So 2 of the things that Kirsten handed out were like testimonial letters. One guy was part of the architect and design construction management for the Twins ballpark. And we're not a big agency, but for those that know us, we're primarily referral based. And he got a hold of us, and he had a big contract, and he needed help. And so we did that, and he was flat out honest. I don't like insurance people, and that's what his letter said, and that's what he told me. I'm like, that's okay. I don't like most of them I meet either, so that's fine. But at the end of the day, we were a partner. We did work with him to try to find ways that were not insurance related. And so whether they're little or big, and no matter what they do, we kind of understand what their exposure is, and we work with them. So I said, to insure or not to insure, that's the question. That's usually where people start when they're new into business, and this is always the last thing that they tend to do. But you can talk to an insurance person, and they can usually give you good feedback before you maybe sign that first contract or take that client on or put out on your website that you do something that maybe is going to hurt you later. So that's all I have for you today. And oh, in your little packet, do I have 30 seconds? I have a test. I love tests because I have kids. So in here, this is really, really basic, but everybody probably got here in an auto. It says examples of liability limits. I just want people to understand how their auto liability works because it still stuns me that nobody explains this to clients. This is your personal auto. So I used a limit of 100, 300. It's 100,000 per person, 300,000 per accident. And I put down here, you know, if you have an accident with 3 people and their medical bills are 150, 150, you have 300,000. I said, well, how much is the maximum that each person receives? And then what are you left responsible for? And then last question is, if only one of them is injured at 150,000, how much does the insurance company pay? Anybody want to take a shot at it real quick? Kirsten. So, anybody know? Out of the first one where you have 300,000 in claims with 3 people, how much is the insurance company paying for John?
100,000.
Yep. How much for Jane?
100,000.
Yep. How much for Jimmy?
50.
Yep. So how much are you left responsible for?
50,000.
There you go. So I have on the back I have on the back table travel mugs, 1 beer, 1 wine, and 1 non-alcoholic that are awfully cool, 1 flashes, so you get first choice of whatever you want from there. And the point of this really is that everybody has an auto. You really need to know how this plays out because people get mad when they have 1 person hurt and they thought they had 300,000 and they don't. So it's all in the details how that works. That's it. Let's see. I have lots of fun things in the box I'd like to get rid of, but I don't know if there's any fuzzy bunnies in there. So, but I tell people, you know, I do tell them when they're forming their businesses, you know, you're better off calling yourself, if you make explosives, call yourself the, you know, the Great Fuzzy Bunny Company, because the first impression the company has when they go to insure you is, you know, oh, that's nice. But if you make fuzzy bunnies, don't call yourself TNT Explosive Rabbits, because I don't care what your website says or what you fill out an application, you're going to lose opportunities. So it's interesting how marketing plays into perception on insurance and risk. So that's all I got. Thank you.